David Kudla joins us. He knows what he's doing. Founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital Management, zooming in from the lovely Troy, Michigan, suburb of Detroit. Been there, done that. David, what do you tell your clients? Again, just a few days ago, we were looking at it. What was that technical correction in the S&P 500? What do you tell your clients when you see moves like that?
Good morning, Paul. Yeah, this was a fast correction. Historically, in the time horizon that it went down, so it caught people's attention in that regard. What we like to think is we've educated our clients well enough that they know not to get too excited about 5 or 8 or 10 or even 12% pullbacks. And in this case, I think the difference here is there is an argument to be made that we've bottomed out and we're gonna climb back higher from here. I think there's an argument to be made too, though, with the uncertainty about tariffs, with the forecast we have for slowing economic growth, inflation remaining sticky at a higher level, that we could see some more volatility here as we work our way through 2025.
So what do you? I mean, one of the concerns I think for some investors is that they say, boy, a lot of this weakness in the markets have been kind of a result of the uncertainty associated with some economic policies coming out of Washington, D.C., principally all the tariff talk and the back and forth. One could argue that's not going anywhere. Does that concern you that this might be a kind of a headwind for maybe a fairly long period of time?
Yeah, it's definitely a headwind for the markets now. I think that's what the 10% correction showed us. What does the market hate the worst? The single thing it hates the worst is uncertainty. And the way the tariffs have been rolled out and pulled back, it's been a little bit erratic. We know what the long game is that Trump and his administration are trying to accomplish, but it is creating enough uncertainty that there's a lot of anxiety within the market. That's why we think volatility increases, even if we don't have further downside from here in the near term. So, that is a concern. That's why, we look at how can we diverse away from U.S. stocks, not just diversify between growth and value or small and mid cap, but, why opportunities abroad, like in Europe, look even better. Liquid alternatives we like to use in times like this, where we can use them in our portfolio as another asset class to help dampen volatility, not necessarily dependent on the indexes, either stock or bond. So those are the things that we start doing, versus the last 2 years where, I consider that really a raging bull market. We had a little over a 2-year period where the S&P 500 was up 70%. 2025 is going to look a lot different.
Yeah, and there is a narrative in the market that if more capital leaves the U.S. for Europe, that's going to come in many different forms. Capital leaving the bond market, capital leaving the credit market. Mag 7 is going to get hit even harder because that was where all the real sticky money is. Do you see that as a real risk?
Yeah, I do. Good morning, Alex. Yeah, we just saw a stat that hedge funds are, now setting records for the amount of longs they have in Europe versus shorts in the U.S. We've been in that trade of moving abroad to Europe for a while. It's probably getting a little bit crowded now. We think it still makes sense. Europe we have lower valuations abroad. We're quite expensive here in the U.S. Even with the sell-off, we're still historically expensive in our PEs and U.S. stocks. Europe and other foreign markets have lower PEs, lower valuations. And, with this news of the fiscal stimulus that's coming in Europe because of President Trump pulling back from NATO, questions about what he'll do in Ukraine, Germany has a massive fiscal stimulus spending package coming up that's going to boost European stocks, even though the fundamentals weren't quite as good there as they were in the U.S., say just 6 months ago. The landscape is changing, making Europe in particular in foreign markets attractive, and certainly this year more attractive than the U.S.
All right, David, thank you so much. We appreciate that. David Kudla, he's a founder, Chief Executive Officer, and Chief Investment Strategist at Mainstay Capital.